Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us each and every week. You know, we come to you several different ways. We talked a little bit about it earlier in the segment. One of the ways we come to is KCAA, terrestrial radio, and they're in the Inland Empire and have been there for years. And we've been with that station with Fred and everybody out there for a long time. They have a terrific AM and FM signal, and they reach really from Riverside to San Bernardino all the way out to Palm Springs, some parts of LA County, Orange County, and even up in Indio. So I really appreciate them, and you can catch them on Saturday and Sunday. If you want to, see us, go to YouTube. Jeff Barton, The Mortgage Voice is YouTube, and you can go there anytime to see not only this week's show, but hundreds of shows in the past. You kind of see the progression of what's happened in the mortgage industry, as well as any number of the great guests that we have come on the show. So thank you very much once again for coming on the show. For listening to the show, and I am Jeff Barton, and this is The Mortgage Voice. Okay, we talked a little bit earlier in the show about rates. Mortgage interest rates have really climbed a lot. And now that's saying something too, right? Over the past 2-3 years, we've seen interest rates climb from 3% all the way up to 7%. Well, now we're over 7%. Once again, 30-year fixed rate loan today, 7.22%. We anticipate that actually going higher. Why? Because people are still getting hired. The labor market is tight. There's still 11 million jobs available. So how far and how much can this change over a short period of time? We're not sure. But what we do see is a labor market that keeps hiring. Private market jobs out there from ADP, 445,000 last month. That's incredible. By the time this airs, we will have the normal unemployment payroll, and they're probably going to go up from anywhere from 250,000 all the way up to 400,000. These are incredible numbers, and more people are going to work. There was an interesting article today, as well as on radio. I listen to Bloomberg Radio a lot. I don't know if anybody out there does. It's a great resource for you to know what's happening economically, not only in the United States, but around the world. Now, stocks and stock picking and all that kind of stuff, I'm really not up on it 100%, but they do have interesting guests, and the guests that they bring on are always talking about what's going on in the world economy, what's going on right here in America. So that's my plug for Bloomberg. Great place to go and pick up some great economic news. 6.65 is the 15-year rate, 7% is the FHA rate, 6.98 is the jumbo rate, and 7.02 is the 5-1 ARM. Now you can see the trend on all this is over 7%. Next week, week after that, we're going to have the Fed chime in with what they think should be doing. I think everybody would, the stock market, speaking of stock market really has been hammered because of the employment and the employment figures that are out there are so strong. Everybody's worried that the Fed is going to raise rates once again, which of course they already signaled that they were. There were several board members, the Fed board, who said that they probably would have raised rates last month, but the pause came as a result of a consensus, not necessarily unanimous, but it was a consensus out there that maybe we should pause. People get worried when rates go too high, too long, and never stop coming down. They're worried about recession. They're worried about jobs, obviously, but with these strong jobs numbers, the Fed is obviously going to step in. People are calling for, not people, but the Fed is indicating that 2 more rate hikes for this year, another 25 basis points this meeting, and another 25 basis points in the fall meeting in September. These are the things that will help lift the short-term interest rate borrowing capacity bank to bank to around almost 6%, which is really quite amazing. I mean, when you think about where we were just a scant 2 years ago, even 18 months ago, compared to where we are today. Now, all of this is in support of what? Lowering inflation. The inflation out there, yes, it's been too high. It was at 9% a year ago. Today is at 4%. It's still 2% beyond what the Fed has targeted as the inflation rate at 2%. Yes, that's true. But I don't know if you remember it. I'm going to explain it. About a year ago, a year and a half ago, before inflation kicked in, whenever that was, say October of last year, so 2 years ago. So yeah, it's about 18 months or so. The Fed was talking about trying to raise the inflation, the target being between 2 and 3%. Now the target is at 2%, but nobody's brought that up anymore, meaning that they thought some amount of inflation was good for the economy, whether it was good for the labor force, i.e. you're making more money in order to get employed, in order to keep the economy going, or you raised your product, your prices, so that you were able to either make a bigger margin, more profit, or be able to share that with your employees. Now they're only talking about 2%. Maybe because we had 9% inflation, and then it went down to now 4%. I don't know, but nobody brings that up as if that particular strategy of the Fed at the time was only indicative of a very narrow set of circumstances, which we've obviously gone well past. Okay, a couple other things that I wanted to get to. The 2-year and the 10-year. So the 2-year we often talk about as being a indicator of recession. And I say that because the yield on the 2-year is currently 100 basis points more than the yield on the 10-year. So if you're thinking about it in any other way, think about short-term debt is usually cheaper than long-term debt. Well, it's the reverse. So the yield being almost 5% on the 2-year, and the yield on the 10-year is about 4%. That usually indicates recession. Now, I talk about it every week, and the reason I talk about it every week is because the economists around the country talk about it every week, meaning this signal has been flashing red like this for a year, whereby we have this inversion where the 2 is greater than the 10. Now, overall bonds, what's going on? What is a bond? Everybody knows that when the U.S. government needs money, they sell treasury notes, bonds. Those treasury notes have to carry with it an incentive for the buyer to buy the bond, i.e., it's a yield. How much are you going to pay me to buy this bond? Over the 10-year, it's 4%. Over the 2-year, it's 5%. So you're going to pay me 5% while I give you this money now for this bond. That's how it works. That's how debt in the United States works. It's how debt municipally in a municipality works, whether it's your small town, San Bernardino, Riverside, or your county or your state. This is how debt works. In all of these circumstances, what has happened over the past year is because we have this inversion, we've had to sell debt at a higher yield in order to get people to buy U.S. debt. Now, is that a good thing or a bad thing? I heard today an economic report out talking about the long-term effects of buying on the debt, meaning that we haven't had a surplus and we keep borrowing money that we don't have. This is why the budget deal was so important, to try to get some momentum towards cutting spending. Cutting spending, increasing revenue, these are the things that are buzzwords in the political world, but in the reality of lending, i.e., I'm going to buy this bond, it's going to give me this yield, is that good for either your municipality, your state, or your federal government? Because in the long run, somebody's going to have to pay the price or have all of the benefits that they're getting cut. Now, they're already talking about cutting Social Security. I understand that. And there's a part of me that says, yeah, we shouldn't really be spending more than we're making. There is a part of me that says that. And there's also deficit spending, which has been going on since before Reagan. Although Reagan made it famous when he talked about supply side. That's another word for deficit spending, whereby you supply enough money to the private sector, i.e., issuing public debt, in order to spur the private sector to investment, i.e. revenues go up. Now, it works for a certain amount of time, but when you've got $1 trillion in the Defense Department and you've got the other 2/3 of the economy tied up with Social Security, welfare, and Medicaid, Medicaid and Medicare, these programs, there's not a lot left over. Anyway, this was the interview I heard today on Bloomberg. Very, very interesting. So you're the person out there, you want to buy a house. How does all this affect you? Because the availability of funds in the marketplace is dependent solely on the bank's ability to borrow from the federal government. And that ability keeps getting pushed higher. It's now at 5.25%. By the end of the year, it might be at 6%, which limits the ability of the bank to lend you money. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. You know, we bring this information to you each and every week. We try to help you with the decisions you got to make. This has been a very, I guess I've been saying that for about 5 years now, but it's a very unusual time in the mortgage industry where we see rates rising unbelievably again, but then again, the real estate out there is not all that plentiful. You would think if prices keep rising, there would be more and more properties out there and prices would eventually drop, i.e. real estate prices. Well, that's not really happening. So what we're seeing is a very pressurized marketplace whereby people are saying, hey, if I don't get in now, what are the rates going to be next month? Or maybe there's less inventory today than there's going to be than there was, or that there is more today than there will be. All these things are combined to try to drive people crazy. Anyway, I'm Jeff Barton, your voice in the mortgage industry. If you want to see us, hear us each and every week, go to YouTube, Jeff Barton, the Mortgage Voice, where we house the show that we shoot for video and also on the radio at KCAA, our partner out in the Inland Empire, i.e., hi to everybody out there at KCAA, Riverside, San Bernardino counties, and everybody in between, whether it's Los Angeles, Orange County, out all the way out to Palm Springs. So this week, what I've done is divided the show up into several different segments, whereby we bring experts on to the show to tell you and help you figure out exactly what you should be doing with the strategy to either buy or refinance. Refinance, maybe to take some money out because they got all that equity in there and you don't know what to do with it. And for purchase people, well, yes, you got to, 1, have the money to put down, 2, you got to qualify, and 3, you got to get to the closing table. There's only one person out in that area that I would go to. It's Connie Hernandez from PMC, and she joins us now. Connie, how are you?
Fine. Thank you, Jeff. Thank you for that great introduction.
Oh, thank you, Connie, and thanks once again for coming on. I really appreciate it.
Not a problem.
Okay, so I talked a little bit about real estate. It's a little bit maddening for those who have been around a long time, or even the last 10 years, that we've seen this up and down cycle, and now we're in another cycle where properties don't seem to be around, mortgage rates seems to be high, but the demand is still there, as well as the prices keep rising. What do you make of this, and when do you see some kind of break for the average person out there trying to buy a house?
Well, my opinion is, we in California still live in a very desirable state. So even though prices seem to be always increasing and that expected price of homes going down just didn't quite happen, I believe that there is still a lot of desirability for other people in other states. I mean, we still have people moving in. For a short time, I heard and actually seen a little bit of it myself, where people were looking to move out of state, quite more than the usual amount. But I think that kind of a panic kind of subsided a little time back. And, people are just not, you're right, the inventory is not there, so obviously supply and demand, right? Mm-hmm. And we're not seeing, of course, 20 offers on one property, but there's still a healthy amount of offers. You're still competing. Right. And for those areas where, the competition is not there, but you really do want to purchase a home, the sellers really do want to sell the home, and they're in some type of a hurry, which could be a lot of multiple situations. Mm-hmm. The discouraging part has been for the past few months that the interest rates are kind of crazy. Yep. But I have seen, and I've actually modeled a few of the loans that I'm working on, where I talk to the agents, and rather than, making an offer and asking the sellers to give seller credit for closing costs, we specifically say we'd like to give the sellers credit to buy down their interest rate. So by doing that, you as a loan officer have specific amounts of money that are available to help the borrowers get a better interest rate. Now, of course, buying down an interest rate can be costly,
Yep.
but that is definitely an option. It's kind of a thing where I've seen the sellers have a bit more empathy for, helping those buyers get a lower interest rate than it is actually to help them with closing costs. I'm not sure quite what the emotional draw is for that, but, of course, the goal is for them to sell their property. And, I think everybody feels the tension of the interest rate still being high. So sometimes, maybe they want to be that good guy that helps that borrower get into the home. I'm not exactly sure ultimately what it is, but it has worked in several occasions. That's just one option. I mean, right now, as you mentioned, there's a lot of equity in properties. There's opportunities for people to consider, garage conversions to ADUs. There's great HELOC programs out there that can help them achieve that without a full refinance. So there's definitely some opportunities. You just have to find those clients and fit their needs. It's always about fitting the client's needs.
We talk a lot about how to get a leg up when you're in these multiple offer situations. I know we talk about pre-approvals, pre-qualified. You did mention that maybe a private talk with the seller or seller's agent by the loan officer, someone like yourself. What are some of the things? Now, everyone says, well, what's the trick? There is no trick, of course, but what are some of the things that you advise your own clients to do in order to really put the best foot forward and to be able to compete at the highest level?
Absolutely. The one thing that is the most important thing for me, and why I think that I've had a lot of success with a lot of the real estate agents that I've worked with over the many years in this business, is that when realtors come to me and ask me to pre-qualify their clients, I do not just pre-qualify their clients. I look for a situation where my investor or my lender is going to give me a full approval, meaning that realistically, if we needed to close an escrow in 15 days, we could. The only thing that we would need at that point is obviously the property, the appraisal, and a few days of contingencies for CDs that need to be signed. But we can most definitely close an escrow in 15 days. It's so important for them to be fully approved rather than just pre-qualified.
I agree.
Would say that would be the number one thing.
No, I agree with that 100%. I think what happens with most well, let me just ask you a question. Give me a little bit of a profile of the typical person that's walking in the door nowadays. Are they savvy investors? Are they people that are first-timers? Are they step-up or step-down people? What kind of people are they?
Well, to be quite honest, because I think that depends on what you market for in your area. Obviously, the areas and your marketing has a lot to do with that.
Sure.
And, there are some loan officers out there that specialize in helping investors, others that first-time home buyers is their niche. So I do see a huge push right now, and even in marketing, for first-time home buyer programs right now. I'll be quite honest with you. I've never been a huge fan of them because there's just so many obstacles you have to overcome. But, if you have the time and the will and the patience, those are great opportunities as well. Obviously, if you don't have the time, permitting that you don't need a short escrow, and patience being that most of these agencies, there's going to be a situation where you're on a waiting list for those monies, but there is a big push for first-time homebuyer programs out there in marketing. But again, they're just kind of each individual, areas, loan officers, their backgrounds, their experience. I think all that has to do and plays a big part as far as what your niche is. But myself personally in our area, we're in the Covina, West Covina, San Gabriel Valley area.
Right.
Homes are not inexpensive. And
right.
We are working with professionals for the most part. So, with some, most of them are professionals either in the medical field or legal field. The price range homes that we have for the most part in the higher end areas, 800 to 1.5 million.
Right.
So, in our areas, that's what we mostly work with.
Okay, we have about a minute left, Connie. Can you just shout out a way by which people can get in touch with you? Let them know where they can get a great loan over in West Covina?
Oh, absolutely. Thank you so much.
Sure.
Connie Hernandez. My direct number is 422-2017. Our office number 626-918-2419. You can find us on right in the corner of Bedell and Citrus, 101 North Citrus, the city of Covina. We have a lot of great programs available for buyers out there, first-time home buyers, self-employed. There's definitely no lack of programs right now.
Excellent, Connie. Thank you very much for coming on once again. We'll have to catch up real soon because market's really changing. I mean, we haven't seen these upward momentum in the mortgage rates. They don't look like they're going to come back down for a while either, just because there seems to be this grand push to try to slow the economy.
I agree.
Yeah.
I definitely agree. So there's definitely, we have to come up with creative ways of helping our clients.
I agree. Connie, thank you very much for coming on the show.
Thank you, Jeff.
Thank you very much. That's Connie Hernandez from PMA. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us each and every week as we bring to you not only great guests, but information that you're going to need in order to get a mortgage or buy some real estate or figure out what to do with the equity. You're in a 3%, but you got all this equity. How are you going to access it, and what are you going to invest in? There's so many things out there in the marketplace right now which are new, different, and unique to this market than really has happened in like forever. I mean, we've seen markets really change a lot in the last 10 to 15 years. I mean, up and down, up and down. During COVID, the mortgages, unbelievably low. Currently, mortgages, unbelievably high. So if you've been around and alive the last 18 months, you know what I'm talking about. But really, one of the people that helps us really understand that, especially in a city like Atlanta, where Malibu Funding, who sponsors this show, does some business down there. But she's our local expert, comes on the show, talks about what's going on down in Atlanta, Georgia, is Luwana Bradford from the Bradford Group. Luwana, how are you?
I'm doing well, Jeff. Thank you again for having me on the show. How's it going with you?
I'm fine, thank you. And thank you very much again for coming on the show. We always come to you for the expertise about what's happening in the ATL. Give us a little oversight as to how interest rates have affected the market, and do you still see prices in the real estate market rising?
Yes, prices are rising. Interest rates have slowed down the buying process. I mean, people are still buying,
right?
But it's just a little bit more crippling for that first-time home buyer.
Yep.
With our average home price ranging around $3,600.
Right.
360,000, not 3,600. Everyone would be buying property, right?
Well, I thought you meant the monthly, so I wasn't going to say anything. But yeah, I knew what you meant. No, yes, I think I'll invest today. How do I get a hold of one of those properties? Oh, that's very funny. So with prices being what they are, the employment situation is pretty good down there. A lot of people still working. I really come down to Atlanta about once a month. Just because I have family down there who are not doing well. How is that affecting the employment, the availability of housing? Is it just making it so that everybody wants to buy, or tell me about that?
We have more demand than inventory. I mean, our inventory supply is about 2.5 months worth, and that's it. So,
right.
And that's also keeping the prices held at where they are, because it's literally a buying frenzy, right? People are willing to pay more than market value for the home if they're able to qualify for it.
Now, we've been talking a little bit on the show today about rents and the rent crisis in a lot of major cities in the U.S., in that families are just, priced out because rents have been skyrocketing. What's that like in Atlanta?
The individuals who I talk to who are renting, right after the pandemic, I guess I should say when the world opened up,
yeah,
it gave those homeowners who were renting their properties, or apartment owners, the latitude to raise rents.
Right.
to very uncomfortable levels. I mean, it's amazing what, 1 or 2 bedroom apartment is going for $1,800.
Oh yeah, yeah. That's amazing. That's
Yeah.
yeah. And what's the average hourly wage down there? Is it still $10, $15? I don't even know what it would be.
Yeah, it's around there, and probably easier to quote what the average household income, dual income, is
Okay.
about 55,000 in Atlanta.
Okay, so $1,800 a month. That's quite a bit because that's you're up and over $25,000 a year for rent.
And then with the cost of living, right?
Yeah, right, right. No, that's
challenge.
and that's 2 people working, right? So
Yes.
yeah, that's a lot. And rents not only there but other places in the country are really causing people to make a decision. Okay, do I am I moving into a shelter? What am I doing? And I don't know if the overcrowding and the homelessness there is affecting, how people live every day. But in major cities, especially a city like where I live out in Los Angeles, it's amazing. It really affects the quality of life quite a bit.
Yeah, I mean, unfortunately, across the nation, we're seeing more and more tent cities being erected. And I find it so
Yep.
interesting that that's a conversation you don't hear much in the media. And it's really disturbing.
Yeah, I agree. I don't know what the answer is as I scratch my head each and every week because I know if you're a couple and you bought your first house and you're doing well and you have some extra money, you want to build some residual income. You think about buying a property and renting it out. I mean, a lot of people think that way. But is that really helping the process or the major corporations to come in and buy 10,000 houses and do that? I mean, what is the supply and demand chain and how has it really been changed during COVID? I mean, since COVID, we really see this rental crisis worse than it has been.
Yeah, and I think, unfortunately, people in positions of influence and control can set the price, right? Because they know the demand. They know you can't afford to buy,
Right.
and you can't afford to be homeless. So,
Right.
What are your alternatives?
That's right, and you don't have a choice, and that's one of the issues where it's not. I don't know. I don't even know if there's a word for it, but you're forced to spend more of your income on rent than you want to spend on rent. And it's not like a mortgage where you have to qualify for the mortgage, whereby your back end and your front end, your DTI, all has to hit ratios. When you're renting, yeah, you fill out an application, but if you can afford the rent, they don't care whether it's 40% of your income or 60% of your income. It's not really, it's not something you have to qualify that way for. So a lot of people get stuck upside down paying more rent than they should. Therefore, their life suffers because the rest of what their bills are can't be paid.
Exactly, and then you think about it, when you're renting, it's your first and last month's rent,
Right.
plus a security deposit.
Right. And damage and fighting them, yeah. Okay,
Yeah.
so now that we haven't figured out anything except describe a problem that exists, tell me a little bit about some of the solutions that Bradford Group is offering its customers.
Well, one of the things that we are really focusing on is we still have a relatively strong investment demand for our single family and the commercial properties that are abandoned, right? So people are looking at buying those. And right now for us, that's about 70% of what we do is on the commercial side or investor single family.
Okay.
But the one thing that I found interesting, and I know you've seen it too, is the investor loans are becoming just as challenging to fund as your residential. The guidelines are much more stringent. I was dealing with one hard money lender yesterday, and they said, "Oh yeah, now we're asking for a minimum 640," and I'm like, "You're a hard money lender."
Right.
Well, that's the guideline now.
And the guidelines by the hard money lender, and for people out there, hard money means a guy has money and they just lend it to you and they make up their own terms and their own conditions to do the loan. So usually credit score is not one of them because you're charging a lot of points and the percentage is very high.
Exactly.
Right, and so
And the term is very short, right?
right, it's a year, right? 1 to 3 years, something like that.
Yes. Mm-hmm.
Right. Right. So what was the outcome of the deal?
The borrower wants to do this refi, and so I'm taking them that route. I mean, fortunately, they have the credit score, but I was just really surprised that,
right, again,
for a 12-month deal, we're focused on credit on an asset-based loan.
Yeah. Okay. So for those of you out there, I'm talking with Luwana Bradford from the Bradford Group down in Atlanta, Georgia. She has a terrific podcast. If anyone wants to listen to something which is both entertaining and educational, Luwana, you want to shout what that podcast is and how someone might be able to listen to it?
Yes, thank you so much.
Sure.
It's called Business and Financial Raw Talk, and it's found on e360tv.com, and you can also find it on LinkedIn. And the podcast is where I discuss with industry leaders, financial experts, about what's happening in the world of business. How can individuals take new techniques, new solutions, new strategies to not only build a sustainable business, but help to empower our economies to flourish. And it starts with that small business owner, because I believe that business owner, those small business is the backbone of our community and economy.
Excellent. Thank you very much. And any other way that you want them to get in touch with you? Just go through the podcast, or do you have a phone number or something?
They can contact me, all things social media, by my name, Luwana Bradford, or if you want to catch me on Instagram, the Luwana Bradford. But you can always call me at 404-618-2824, 404-618-2824. And our website is bradfordgroupmtg.com.
Thank you, Luwana, very much for coming on the show. I always enjoy the conversation.
Thank you so much, Jeff.
Thank you, too. That's Luwana Bradford from the Bradford Group down in Atlanta, Georgia. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in to the show. Each and every week we come to you, we bring to you information. We're trying to help you with decisions that you're making about purchase, refinance. Maybe you're just looking around, kicking the tires at some property. You're trying to figure out whether you can afford it. Maybe it's an investment property. Maybe it's something that you just not quite sure if this is the right move for you, but it's attractive for some reason. You need professionals to help you through the maze of all this information. There's only a couple people that can really do that for you. It's people with boots on the ground or people with tremendous knowledge in the industry. And that would either be real estate people, mortgage people, or a combination of both. We try to bring both of those people to the show each and every week. Once again, Charles Giscombe comes to the show from, where are you today, Charles?
I'm in sunny Florida, except it's raining right now, Naples, Florida.
Okay, from Naples, Florida, and you're really ear to the ground, really know what's the what out there in both the investment as well as, you're doing house flipping and some other stuff. So let me ask you a couple of questions. First of all, hi, how are you? It's nice to talk to you.
Hey, thank you for having me, Jeff. Thank you so much.
Thank you very much. Okay, we're in a difficult market. Obviously, once again, rates are rising. We see employment really up. The government may be trying to quell inflation even more than it already is. I don't know, is 4% all that bad? To me, it doesn't make that big of a difference, but to a lot of people, I guess it does, so they want to make sure that it doesn't continue to rise higher. So we see the Fed raising their own interest rates, which again, tangentially, and as well as your credit card, as well as your car loan and a bunch of other bills, it's expensive out there. How are we helping people in order to get a loan, maybe that they can't afford a conventional loan out there, but maybe there's some other options out there to take advantage of properties that are available?
Absolutely, Jeff. You know what? In this time, obviously, even though we've been through this before, people are still hesitant to pull the trigger in regards to getting in the market. What we have seen is that the property values are maintaining themselves, so it's still a great market to get involved with. So if you are concerned about the interest rates, or you feel like they may be too high based upon where you're currently at in your financial structure, there are many loans out there that can help individuals still get into properties, still write a monthly check as though they're in a better market with a better interest rate. How we do that is we take advantage of that with non-QM loans. Non-QM loans are non-qualified mortgages that are not like traditional mortgages or government loans. They have less restriction. They have less red tape. It allows individuals who have the ability to repay to get into the market. Some of the interesting features that these kind of loans have is have the ability to stretch the amortization out. That means in a normal case, a loan will be 30 years. Non-QM loans have a lot of 40-year options and a lot of interest-only options for 30 and 40-year loans. What that means is if you add in an additional 12 months to 120 months to your loan, what happens is now from a 30 to a 40 year, you're at 360 months. Now you're at 480 months. What happens is that amortization is stretched out over that period of time, which obviously will make your loan payment less. At the same time, it has options that will allow you to only have to pay interest only instead of principal and interest. What that strategy can do is help an individual get into a payment that still meets their financial budget and structure, and allow them an opportunity that if the rates if the rates do decrease, an individual without penalty can refinance into a lower traditional interest rate amount if they consider themselves to be more interest rate conscious. This is one of the many things that you can do in order to get into this market.
Okay, so what you're saying then is there's no recourse, no prepayment penalty on a lot of these loans, or are there? That's what I interrupted you. Sorry about that.
No, that's okay. In these type of loans, there is no prepayment penalty.
Okay.
Now, there are some more aggressive loans if you're into house flipping, house renovation. These loans do have prepayment penalties because if the lender is not charging you anything else except a minor underwriting fee, usually they like to keep you in these loans because interest is how they make their money.
Sure.
But if you buy yourself, you have the ability to buy yourself out of prepayment penalty. For example, most of these loans, a lot of them have a 5-year prepayment penalty. What you do is you can pay 1 point up front to the lender. That will be their payment. That will allow you to only have to stay in this loan for 12 months or less, which means that you can take advantage of the wonderful programs that they have, not have to pay a tremendous amount of money as a penalty to get out of the loan when you're trying to refinance with the strategy that we talked about, and gives you less money that you have to pay when you do decide to get out, whether it's 3 months, 6 months, or less than 12 months. So there's many options that you can have that won't allow you to lock yourself into a loan for extended periods of time.
That's really not a bad deal. 1%, let's say, $500,000 is $5,000. So you pay $5,000 for no prepayment penalty. Maybe the rates drop by a point, 2 points, and it's really worth it for you to be able to do that. You recoup that $5,000 in a year, 2 years. So that's actually a pretty good deal.
Absolutely, Jeff, because you think about it. If you're locked into a 5-year deal and you got a $500,000 loan amount, if you try to do it before the 5 years is up, you'll pay a maximum of $25,000.
Right.
And even if it's 4 years, that's $20,000 on down. So I believe that $5,000 up front will allow you the opportunity to look at other opportunities and other options to lower your interest rate and not be stuck.
What do you see right now? I mean, as a good product for not only someone trying to get into this market, because property values are high, interest rates are high. What's a good program that you like? You personally say, hey, you know what? This is what you should be doing.
I will tell you, Jeff, I talk to a lot of individuals who are entrepreneurs. We have a lot more of them in the market now since COVID, and now a lot of people are home working for themselves and not working for other businesses. One of the loan programs that I love a lot is I love the 12-month non-QM bank statement loan.
Okay.
The reason why I like this loan is because it shows the person's ability to repay just through their bank statement. So if a person has an LLC or a corporation or they work for themselves, with those business bank statements, they can utilize, though, to take the place of their tax returns, and they can qualify for a loan. So now, just imagine this. If you're writing everything off on your tax returns and you're down into the black, or some people even into the red because you're saving money because you are the business and you're writing everything off, that's going to show that you don't have too much income, which would stop you from qualifying for a loan because your debt-to-income ratio will be way out of this hemisphere, which
Sure.
will not allow you to qualify. But if you're using your bank statements and the raw, real money that comes into your statements every month is the money that they see, they will utilize those deposits that you receive in your business account, and they'll take the average of the 12 months, and that will be your new income to go against your debt-to-income ratio. So not only will it take away the tax returns, it's usually and most likely 99% going to be higher than what your tax returns will read, which gives you more option, more cash value, more ability to repay to show for you to qualify for the loan. That's why I like that loan. You can use personal and business bank statements. They will allow you to bulk up and show that you have the ability to repay without having to utilize those tax returns that we so strategically have to do when we're business individuals so that we can keep our money.
Now, the closing costs and such, can you roll all that into the loan? How does that work?
You know what? You have to come with closing costs, but there's options for you. At the end of the day, if you're going to get seller closing costs, if you're going to get closing costs in the transaction, usually I always tell our clients at Malibu Funding, it'd be better for you to pay your closing costs out of your pocket, so that way we don't have to give you an interest rate that will require us to be higher in order for us to get paid. All those closing costs, you do that. If you're doing a refinance, you can absolutely roll those into your closing costs, for sure. But as a purchase, you need to bring that to the table. At Malibu, we love talking to our clients. We call it earning while we learn, so they understand what we're doing and the reason why we're doing what we're doing to give them the rates and the service that we can provide.
Excellent. Hey, Chuck, we're up against it. Could you shout out a way by which people can get a hold of you? Great loan officer. Charles is the qualified employee out in Las Vegas, Nevada. Today he's down in Florida. If you could do that, that would be great.
Absolutely. You can reach me at that good old Las Vegas 702-328-5191. Again, 702-328-5191. Or you can reach me at charles@malibufunding.biz. That's charles@malibufunding.boy Isaac Zenith.
Excellent. Charles, thank you very much once again coming on the show. Always appreciate it, and I always appreciate the information. Thank you.
Thank you for having me, Jeff.
Thanks very much. That's Charles Giscombe from Malibu Funding. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thank you very much for tuning in to the show. You know, you can hear this show on a number of different podcasts. We've been on podcasting for a decade. And some of the podcasts that we're hooked into are through our radio affiliate and partner, KCAA. And Darryl, do you have a list of those podcasts for me?
I sure do. It's Apple Podcasts, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, Podclips.io, and TheMortgageVoice.com.
Excellent. Perfect. TheMortgageVoice.com, that's our own website. If you go there, you can see and hear guests that come on the show. You can find out a way by which you can get in touch with them, as well as, just check us out. I mean, that's our website, and then please show up and click on that you like what we're doing and that you'll continue to watch. Especially on YouTube, you can do that. And obviously, if you go to podclips.io, that is a terrific place where you can centralize your podcasting gets, i.e. if you wanted to talk about health, if you want to talk about finance, which is what my program is on, if you wanted to talk about sports and lifestyle, all kinds of things you can go there and get. Please do so. That's podclips.io. Thank you very much. I am Jeff Barton. This is The Mortgage Voice. Let's get right to some news to you stuff. And there has been a lot of things going on in the news when it comes to real estate and mortgages. Rents have been skyrocketing once again. During the pandemic, we saw rents really go through the roof, and a lot of people were really worried. There was a moratorium on eviction, so even if you weren't paying, you couldn't get kicked out. Well, that particular rate has really gone up, skyrocketed since they've lifted that particular moratorium, and there's a squeeze on housing. There's a lot of problems with housing. Let's just talk it like that. If you go to any street in any U.S. major city, you will see people wandering around with no place to live. They call them homeless or houseless. They're people without a place to go. If you are there at nighttime, you will see tents everywhere, all over sidewalks. Even in smaller towns, you're seeing it. What is the problem with that? Problem with it is that most people can't afford the rents that are being charged. So what is not only your town doing about it, your city doing about it, your state, your country, what is happening to make this better? We live in a place whereby, hey, if I buy a property, I should be able to rent it out for the highest price possible, highest rent I can get. That's what capitalism is. But is that the right thing? Or should we, like they've done in many cities historically, is house them in these large communities, whether it's in high-rise buildings or whether it's in small houses spread out over a small section of land in any place USA? I don't know what the answer is, but it is a major problem. And one of the problems is rents. Rents are skyrocketing. Let me give you an idea of what I'm talking about. Okay, rent hikes and eviction. That was the topic that I wanted to talk about. Rents in Vegas are 60% higher than they were in 2016 to 2018. 2018 was 6 years ago maybe. So it's gone up 60% since then. Where do the people go who can't afford the rents? If that is universal in a place like Las Vegas, so I've had an opportunity to work in Vegas. I've had an opportunity to work with people, Chris McLemore is one person, a couple other people out there who work with homeless people, who go and find them. And surprisingly enough, there are a lot of homeless, a lot of child trafficking in Vegas because of the fact that a lot of these people just don't have a place that they can afford, that they can live. And that's a tragedy. But in Vegas, it's 60%. In Phoenix, it's 40%. So since 2015, 2018, 2016, and 2018, we've seen rents increase by 40%. Dallas-Fort Worth, 40%. Columbus, Ohio, 20%. So you can see that these several cities that I've just mentioned are having that issue whereby rents have risen incredibly in their own particular city. Let's talk about Los Angeles. Let's talk about San Bernardino, Riverside, smaller cities, smaller counties. But rents have risen there as well. Because, look, I'm a person, I work hard, I pay my mortgage, I have a little extra money, I want to buy a unit so that I can gain some financial freedom and get financial flexibility by getting residual income based on the rents I get. And that's a proven, powerful way by which anybody in the U.S. can become wealthy and begin to set their own retirement and legacy to their children or their family for the future. I get all that. But when it becomes a question of squeezing people out of housing that they can or can't afford, then that becomes a legislative problem. And in a city like New York City, my own family did exactly what I just said. New York State passed a law that when you get a renter in there, you can't get rid of them, and that those particular rents in that state are rent controlled. And so, for the most part, individual investors have stopped investing in those properties. Now, has it alleviated the problem? Are there more rental properties available at a reasonable price? That I don't know, and that waits to be seen. I just know that was and has been an avenue for people to, obviously get wealthy and get residual income for generations. Not around anymore. Okay, so that's what I wanted to say really about what's happening between evictions and rent hikes, and that's a major problem. A couple other things. The recession or not. Okay, so in talking to economists, not me personally, but when I listen to interviews about economists and how they talk to each other, the forums they go to, whether it's the American Heritage, whether it's the Brookings, whether it's Housing Wire, whether it's, any number of different sites that you go to. You can read or listen to different interviews of people talking about, okay, are we in a recession? Are we going to go into a recession? Well, it's 50-50, what they call a coin toss right now. Now, earlier in the year, again, another year where I've been completely wrong on this, I said we were absolutely going to go into a recession, probably not until the third quarter. Well, it's the third quarter right now, and people who know way more than I do about the economy say, nope, doesn't look like we're going into a recession. And then, of course, there's the other half that says, well, it might be a recession, but it might be a mild recession. But what does that mean to you? I just quoted you some statistics in the last segment or a couple segments ago about employment and about how the hiring has really continued to go up. We're hiring 500,000 people a month, well above, almost twice as much as economists had predicted. It's really an incredible situation where we have truly people who are out there working in the economy. The economy is growing, but yet we still have the fear because the Fed keeps raising rates. As I said before, 5.25%, end of the year be 6%. Because the borrowing cost for corporations is higher, what we've seen is more people go into bankruptcy, corporations go into bankruptcy this year than we've seen. Well, where's the statistic? It's right here. Since 68% increase in bankruptcies in 2023. It's the highest rate since 2010. Now, 2010, everybody knows we just came out of the recession, the Great Recession. Yes, that was a problem. Obviously, corporations at that time couldn't borrow money because, it was very, very tight and banks weren't lending money. In this case, this is a Fed-induced bankruptcy, meaning they raised the rate so high that a company just couldn't borrow the money that they needed to operate or grow in order to provide whatever margin they had, thin or otherwise, to be able to keep the company open. So we see a spike in increases in bankruptcies. And of course, the Fed rate rise is what is to blame. Housing, back to housing. Let's talk about the office building crisis in major cities in America. Another issue that looming on the horizon is all of the buildings that now have remote workers, or that companies have seen, hey, we don't need as many people, or they've just cut workforce because they were worried about the recession. There is, in many major cities, Los Angeles being in one, New York City, Chicago, you name the city, I can tell you there are office buildings there empty. And those empty office buildings, what are they doing about it? So the people who lent money on the office buildings who are now not being able to pay off the note in order to buy the building or build the building, what happens to those? When those buildings start defaulting on those loans, it's going to be a major problem, and it's one that's right around the corner. So the conversion from office building to residential, how much does it cost? How can you recoup? What kind of living spaces is that going to be? This is a major topic to a lot of people who are in civic planning. And I just wanted to bring that up because it is a big deal. If you're out there right now and you own office space, I feel bad for you. Anyway, Barton, your voice in the mortgage industry. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.